Thanks for coming on.
Yeah, thanks for having me.
Awesome. How's your weekend, by the way?
Yes, very good.
Yeah, get up to much?
Spend it with family, to be honest.
Did ya?
I pushed work aside for the weekend, and my busiest week in the business in the last week, and although I should have been working, I decided just to spend it with the family. So
beautiful. And so family as in...
My wife and kid. Yeah, I've got a son, 2 years old. Yeah.
Fantastic.
Yeah, very good.
So how long have you been married for now?
We've been married 4 years, and together for 7.
Oh, beautiful.
Yeah. So,
yeah. And so how's the little one?
He's 2.
2?
Yes.
Yeah?
Yes.
What's his name?
Alessandro.
Is that a family name?
No, Alessandro, no. Just we decided that we liked it.
Yeah?
And to be honest, when I was a chef, I worked with a fresh off the boat Italian in a restaurant, and his name was Alessandro with the nickname Ale.
And it was cool as, right?
Cool,
yeah.
swagger, and I was like, I like that name, you know.
Yeah.
And then when I met my wife, we were talking names, and she also liked it. So
Yeah.
just both totally random.
It's always hard picking names though, eh?
Oh, yeah.
Like,
definitely.
did you have like a short list of names?
Not really.
Nah.
We basically both liked Alessandro. So if we had a boy, it was always going to be Alessandro. For girls, we sort of had a few names: Isabella, Natalia.
Beautiful
I think
names.
there was one more, but yeah. So we had a couple on the girls' side, but the boy was always going to be Alessandro. So
yeah, nah. So it was the easy one.
yeah,
He was
that's
a boy.
right. Yeah, and it's the first boy in our family in 12 years.
Oh wow.
Yeah, so
it's crazy.
The first grandchild was a boy, then there was 6 girls, and then another boy.
You know, it was funny. I've got a lot of cousins,
Yeah.
right? Our family was boy, girl, boy, girl. Like with all my cousins, that was like just in cycle, boy, girl,
Yeah.
girl. And went like that for pretty much for all the kids until one of my cousins had triplets, twins,
Mm-hmm.
and then that just put it out of balance, right?
That's the same with all our cousins. Was all boy, girl, boy.
Yeah.
And then it went out the window when all the grandkids came along.
Yeah, exactly right.
That's all right.
So you work obviously in finance,
I do,
right?
yeah.
So we've got to know each other over a period of time, right?
Sure.
So before you started in finance, what's sort of been your journey leading up to this?
Well, it's been a journey, that's for sure. So after I left school, I actually pulled out of year 12 to go work in the family business, which is nightclubs in Adelaide. So Hindley Street venues, we have the Palace and Red Square.
Yep.
So went into that, worked there basically up until I was about 2007. I moved to Redcliffe in Queensland, which is just north of Brisbane, because we're doing some property development. So basically went up there for two and a half years just to dabble in some property development for a bit and just be the family's eyes and ears. After we got out of that, I came back and decided I wanted to do my chefing apprenticeship, which is where I worked in the restaurant that I met Alessandro. It used to be called Auger on Grote Street, fine dining Italian restaurant. So probably about just under 2 years into my apprenticeship, I injured my back, and I did my L5S1 disc, so I had to go on work cover. I was basically a mismanaged claim on work cover, and from the start of my claim till the end of my claim was basically 5 years. It took me 5 years to get properly back into the workforce. I was ready to return to work on light duties after 3 months, but because I was just so mismanaged, it took them so long. I had to sue work cover twice, just because of the way that they managed it. And a part of me showing that I was keeping up to my end of the bargain was basically retraining. And I decided to do finance broking just as a part of my retraining.
Sure.
So by the time we had finished the second court case, I'd actually, because I had to keep playing along to show I was doing my part, I was a finance broker for 3 years.
Yeah.
Opened a business under a different brand, learnt the ropes and was actually doing the work for 3 years. After that time, or during that time I should say, my parents went through a divorce.
Okay.
And my brother was pretty much put as the managing director of the family businesses. It was getting a little bit tough to play the middleman between the two parties to be able to run the businesses effectively. So he came to me and my sister, said, look, I want to look at doing a buyout. Do you guys want to come back into the business? So sold out my finance book and went back to the family business in probably I think it was 2016, the start of. Went back into restaurants and basically spent 3 years there. We sort of all had a 5-year plan, we all put in 5 years, and we can sort of sit back and the business will be at a level that we can just do whatever we want.
Sure.
Little did we know that in that time the Adelaide restaurant industry would plummet as it did, with all the small venues opening up. We used to own the Curious Squire in North Adelaide.
Oh, did you?
Yeah, we basically...
I ate there a few times, actually.
Yeah.
That was good food there.
Yeah, it was good, especially when I was in the kitchen, that's for sure.
Well, they actually sponsored Adelaide Cobras as well.
That's right.
And that's how when I was playing there, that's how I got there for a sponsors night.
Yeah.
That was the first time I went. But
yeah, that's right. We've always been heavily involved with Nick Giorgio down there, so...
Yeah.
But yeah, so we eventually just walked away from that, had to shut up shop and leave, just because, as you've seen in the area, O'Connell Street is ghost town these days.
Oh, it's crazy.
We had just opened up another restaurant in King William Street, which, we decided to offload as well, which we've done now, and basically retract just back to Hindley Street, which has always been the cash cow of the family group, nightclubs, no food, just pure alcohol
just party.
sales. Yeah, that's right. And hey, it's been the backbone. My dad started in the nightclub industry in the 70s.
Wow.
So that's how he grew our family. But then I had to go back to work at Hindley Street once we offloaded these restaurants. And because we already had a management structure in place there, it wasn't so easy just to come in and say, okay, well, you've lost your job, I'm going to take over as manager. So I basically ended up working on the door again, because we subcontracted the doorman work, right? So we can offload a subcontractor, no problem. So,
right. We'll sub out to security companies for that sort of thing,
so
don't you?
Okay, well, these nights we need one less guard, basically. And was there for about 18 months on the door. And the first year of my son's life just went straight by me. And I just basically woke up one day and said, nah, enough. So it's all good to be in a business where the group was doing at the time probably about 10 million in revenue a year, and the ego gets overly inflated by that, because you see the numbers and we're great, we're part of this big business, but you've actually chained to it, and especially in hospitality, if you're not on the ground managing, and you give, especially in the nightclub industry, if you look at your staff in the nightclub industry, they're between 18 and 25. You give someone the reins to a nightclub, and all of a sudden they're the next biggest thing. All their friends are in for free, they're drinking for free. So
that's true.
And we tried that, and they basically destroyed what we built over 15 years. So we had to go back in there, redevelop the whole inside of the club, and basically rebrand and start fresh.
It's a big move.
It is, yeah. So it's the fact that I didn't want to do it anymore.
Yeah.
5 nights a week on the door is just too much.
Insane, yeah. And I grew up always sort of in family businesses. Like my parents had cafes and stuff. So growing up, I'd always be helping out at the cafe. Since I was like 5 years old, I'd be going there, helping out after school. You go straight to the cafe, you help out the family business, that sort of thing too. Which I think is like a kind of catalyst for my entrepreneurship and sort of going into different fields and having different businesses and that sort of thing too, right? But there's always a little bit of a different dynamic when it comes to like family business, and it's always a little bit more complicated in some aspects to sort of manage it when you're dealing with family too. Did you find that as well when working with family?
Being the baby and the black sheep.
Yeah. You're the baby too, are you? You're the baby. Yeah, I'm a baby too. Okay. Yeah.
So, after selling my finance book and going back to it, it took me maybe 2 or 3 months before I started hating the decision, purely because, and we worked on it, we just could not distinguish family from business. The family dynamic was just overtaking the relationships in the business, and that's not a good way to run a business, basically. So it's very difficult.
It is. And so now you've just hit the ground running with sort of finance.
Yeah, well, that's it. So when I decided that I wanted to get out of the nightclub industry, it was like, well, what can I go back into, or what do I want to do? And actually a friend of mine who's a mortgage broker called me one day, and just when I saw his name flash up on the phone, it was just a gut feeling, finance is what I got to get back into. And this time I'll I contemplated going to work under a brand again because I thought, well, I need to be retrained. It's been 3-4 years since I've been in the industry. Basically didn't give myself the credit to be able to do it for myself. And
Sure.
then I just decided after, I fully got set up under this brand again and agreed to the terms, and I was sort of sitting there and I was just thinking, like, how hard can it really be?
Yeah.
Banks have BDMs, there's all these support people in the industry that you can learn everything from. It might be a little bit harder and I have to spend a little bit more time. But I'd rather keep that chunk that I'd be kicking up to someone and keep it for my family.
Yeah, of course. So, and you've been doing some amazing things too, like some complicated cases that I've seen, and you've managed to get $1 million in lending and that sort of thing too, which is crazy. Yeah. But you've also got a bit of a niche for first home buyers too, and understanding that, because there's, different parts of finance which have sort of different regulations, different things that can. I mean, obviously with first home buyers, there's always incentives and there's first homeowner grants and that sort of thing too, which obviously help first homeowners out, first home buyers out. So at the moment, I mean, I know it changes sort of year to year, and there's always more things coming out. But currently, right now, so what's sort of the best things on offer for, say, first home buyers when they're looking at it?
Okay, so. There's obviously the first homeowners grant, which they can take advantage of from the government, $15,000 for a newly built, or if they construct. If they're not so picky on where they want to live, and it's just more so let's get into the market. For an example, I had a client who didn't have any deposit saved up. Came to me asking what can she do. I got in contact with a builder broker that I knew. Yep. We managed to put this project together where she would get the first homeowners grant. She would get about a $10,000 builder's grant, and the developer was offering $32,000 on the land.
Oh yeah, nice.
As a developer's grant.
Yeah,
so
right.
We ended up with about $56,000 worth of grants from the government and these private builders and developers that she didn't have to put a cent of deposit into it.
Yeah, right.
So that's going through the works now at the moment. It's going to go to Home Start, but it's more so about finding someone that is going to work with you from a client to broker point of view.
Yep.
Too many brokers in the industry on all my videos you probably see me talk about cookie cutter deals, or some people call them vanilla deals, where they don't have to think outside the box, and it's just purely, okay, well, that's a clean deal, we're going to send it to this lender, where that just makes you a bit of a glorified admin staff for the bank, where I like to think outside the box and puzzle these things together. So finding someone that will work with you to get the best outcome, but then also on the flip side, from the broker to client, the client has to be realistic about their expectations. Sure.
So let's take it back. So pretend I'm a first home buyer. Let's take it back and I really give them sort of an education through what we're doing here today. I'm a first home buyer. I want to buy a house. Where do I start? Like, what do I have to look at initially to say, okay, I'm sort of getting ready to buy a house now. Like, what's the first thing I should be looking at?
Yeah. Okay. So there's two sides that you need to look at. And that's why even if you're just looking, you've got to get in contact with a professional, a broker. Never go direct to the bank, because they only know one thing,
So can you explain that a little bit more? So the difference between a broker and a bank?
Yeah, okay. A broker, we basically, we can sell the products of about 30 plus lenders. So most brokers should know the policies for all those banks that they sell.
Yeah.
So you might come to me with a certain scenario. We've got this much deposit. We've been casual employment for 8 months, and we've got some overtime that we need to use for servicing and so forth. I know which bank will do that deal. Whereas if you walk into a branch of a bank and you give them that scenario, they'll either say yes or no, we can't do it.
Sure.
They won't tell you where to go.
So they pretty much push their own product that they have available, right? And it might not even suit me as a first home buyer for my situation, because I might have a little bit of a complex situation. I might not have much of a deposit, but I've got good earnings, or vice versa.
That's right.
So through going through a broker, really, because you guys get paid from the bank directly, the client's not really paying you, which obviously through the election that still stayed the same. That just happened, right?
That's right. Yeah.
But so because of that, you're really just tailoring it to that client's position, right? And finding the best rate and the best loan for them in their current situation, where they're not going to get reamed an extra percent and a half, 2%, because they're loyal to a big four bank, which I've always been with since they were a kid, right? Which is a lot of people, right? Because if I've been comfortable with Commonwealth since I was a kid and I don't really shop around, I've got multiple accounts of them or whatever it may be, just because it's close to my house and it's been convenient, and I'm going then to go get an approval for my loan for my first home, they might not have the best deal for me, but I don't know that because I'm just going by what the bank manager says. But if you are listening out there, always go see a broker. That's something I always tell people. Dan's saying it right now. I mean, it's something definitely to do. It doesn't cost you anything, but it's going to give you more options for your situation, definitely.
Yeah, that's right. 100%. And banks work on volume and turnover.
All right.
You're a name and a number on a piece of paper. So, a vast majority of my clients who come into me say, oh, well, I've been banking with CBA for 15 years, for example, and they turned me down on this home loan. Okay, did you put an application in? Yeah, they told me to put an application in. Okay, so they know that if they just keep putting applications in, eventually they're going to get enough approvals to make it worth their while.
Sure.
But also the fact is, gone are the days of the bank manager relationship. Your dad probably told you when you were looking to buy, oh, that's all right, go down, we'll speak to the bank manager and we'll organise a home loan.
Yeah.
Bank managers these days, they don't have the power that they used to do.
Nah, man.
So they might say, oh yeah, cool, we'll look at that, but they still got to send it upstairs to get ticked off by credit assessors and all that sort of stuff.
It's crazy. Like, dude, I spoke to my dad when they were like getting money lent back in the day. They're paying 20%.
Yeah.
20% interest rates. 18, 20%. It was always around that sort of mark. And I remember hearing it back then, but when you're younger, it's just a number,
days,
right?
Yeah, back in the 80s.
Now you come to it now, and we've got some of the best. Well, we do have the best interest rates that we've ever sort of had, right? So we're in a really good time to actually buy. Even if you're in a bit of a difficult situation, there are ways around it now where you can get money through certain lenders, and it's still not going to be anywhere close to the sort of rate you're paying. I mean, unless you're going through a private lender when you're in a bit of a bad situation, going bankrupt, and no one will give you money, but that's not first home buyers. That's people who are a bit more established, right? So the application process would sort of be the next thing, I'm assuming, that would be going through?
Yeah, so sort of just jumping back to those two sides. You've got two sides of the assessment, which will be how much deposit you have, because you need to be able to buy into the property with a certain amount of equity.
Sure.
And then how much you can actually service based on your income and expenses.
Yeah.
Right? So once we work out what you can actually do from that point of view, if the clients are happy, then we can move forward to an application. If they say, okay, well, we might want to get rid of the credit card first, so that opens up a bit more lending, we strategize from that point.
So your credit card affects how much you can lend?
Of course, yeah. So basically, it works out to a 3% monthly repayment. So if you got $5,000, it's $150 a month that they'll put into basically a servicing calculator, which will then take away from how much you can afford.
Is that right?
On the other side, yeah.
Yeah.
So,
okay.
Plus, with what you spend your spend on your credit card, if they look at the statements, then they're going to find what you're spending it on and put that to your living expenses. So it can be a double-edged sword, because if we tailor our living expenses based on just the income we receive, it's going to be a lot less than the income we receive plus $5,000 worth of credit.
Yeah, that's right.
So
it's a bit tough for me because I got sucked into the credit card because I was already spending the money, but I'm like, I want to claim these points, these Qantas frequent flyer points, all that sort of thing. Because I'm like, all right, well, if I'm going to be doing it anyway, paying for petrol, I might as well do it from that and then pay back on to my credit card.
You have to be very disciplined.
Hard, I know. you got those months where it's like a little bit tighter, and it's like, oh my god, I've got to manage out these payments and make sure I still got enough for the family.
It's all
and that
good,
sort of
but
thing.
if you go on a bender and spend $2,000 on a weekend, then that's where it starts.
Well, I guess you know what, we laugh at it, but for a lot of first home buyers, I remember when I'm first home buyer, I had to really look at my situation as well, because I mean, like, I spend crazy money on Uber Eats every week and like going out, lifestyle, just whatever it may be, even lunch during work and that sort of. I'm blowing money just buying things throughout the week,
and
right?
that all adds up.
It does.
To your living expenses.
You don't realise until you actually sit down and look at it. I'm like, oh my god, is that the number? Like, is that actually the number I've been spending per week? Right. So I guess my advice would be looking at your situation first as a first home buyer, what your expenses are, and trying to cut back on those as much as you can, because the banks are going to be looking at, well, for like past 3 months with a fine-tooth comb. They've been looking at everyone's sort of living expenses, Netflix, Uber, all that sort of stuff that you're spending money on just as a lifestyle component.
Yeah.
And it's really affecting the amount of money that people can borrow, right?
Yeah. In some cases, it's killing deals, just because their living expenses are too high. It means that they fall short on what they need. So it is, it's a big thing to buy a house. So it is the biggest transaction that most people will take part in their life. So if you go into it thinking that there's not going to be any sacrifice or discipline involved, then you're in no space to purchase.
That's right.
Especially in a society which is all about the now. When I talk to first home buyers and I tell them, okay, well, you need to put a savings plan in place, and maybe in 2 or 3 years you'll have enough deposit to buy a house.
Sure.
What do you mean 2 or 3 years? Is there a way that we can borrow the money now?
No.
They want it now.
And that's the thing. And that's when it comes down to education, right? Which is a big part of what we're doing today, because, people do need a bit more guidance and a bit more awareness of the situation before they're going into it, so they can prepare themselves, for the few years leading up to when they're going to be ready, right? And as with savings and saving plans and cutting down lifestyle costs and all those sort of things too. All right. So all right, we've got to the approval process or the application process now. Right. Yeah. So as a gauge, you're talking about deposit amount. So is there sort of like a percentage that you normally say? Look, as a sort of gauge of like, I want to spend this much and I need this much as a deposit, or
it all depends, right? So the old rule of thumb was 20%, but 20% is sort of looking at getting out of lender's mortgage insurance territory.
So that's 20% of the purchase price, you're saying?
Well, so it works out. Well, that used to be the rule of thumb, but how it works is basically you've got your purchase price, you got to tap on your stamp duty and government charges, and then you've got to also, if there's mortgage insurance involved, you've got to tap that onto the loan amount as well. So it's the net amount of your purchase price plus the cost to buy minus your deposit. You need to be sitting at no more than 95% of the purchase price.
Yeah, right.
For your loan amount, right?
So that's including with the fees and charges on top.
Yeah, fees and charges on top.
Yeah,
right?
okay.
So the problem that it's hard to give an exact percentage is because the mortgage insurance amount will vary depending on the value of the property, right? So if you're buying a $600,000 property at 95%, then your premium is going to be a lot higher than if you're buying a $300,000 property at 95%, purely because the amount is less to insure.
Sure.
And to clarify, the mortgage insurance is not anything to the benefit of the client. It's not insuring their mortgage, it's the bank insuring anything above 80%. So
okay.
if it's 95% lend, then that extra 15% is insured in case you default on the loan, right? If they have to foreclose on the house, they know that they can fire sale the property for at least 80% of the value, and then the rest is insured.
Okay.
And you pay that premium for the bank to be insured.
That's pretty much the definition of LMI.
Yeah,
so lender's
lender's mortgage insurance,
right?
Yeah,
okay.
Where although it's not to the benefit directly, it is indirectly a benefit to the client because, especially if they're a bit tight on their deposit, right? If you wanted to get out of the mortgage insurance territory, say if your premium was 12 grand, right? And it was 12 grand, you were sitting at about 90% of the lend. If you wanted to get down an extra 10% in the loan amount, and you're buying $400,000 or $500,000 property, and you're looking at an extra 40 to 50 grand, you've got to tip in to be able to get rid of that 10 or 12 grand insurance premium. So the whole structure and the whole model knows this.
Wow.
That although it's a expensive expense, right, it's still a means to an end, because it gets you in the market, and you don't have to save up for another 2 years to get that 40 or 50k to squash that premium altogether. So
sure,
you take a hit to get into the market sooner, basically.
Interesting. So if I'm a first home buyer, what would be the best way for me to purchase? What sort of product would be best suited to my situation?
Well, again, there's no there's no cookie cutter.
Yeah.
Right? So everybody's situation is different. Everybody's different with their banking and how they're set up.
Sure.
But 9 out of 10 times I recommend to first homeowners get into, especially in the current market, just get into a basic variable rate product.
Yep.
Right? You know, for example, bankers say at the moment their basic variable rate is the cheapest on the market. It's 3.24%. You've got a $100 establishment fee and no ongoing fees.
Okay.
Right? Perfect.
Yeah.
That's all they need is a loan account to be able to put their repayments on. If they do have any extra money, they can tip it into the loan account. And although it's not an offset account, they can still offset the interest. Whatever they're ahead of their repayments will still offset the interest. They can still redraw that money from their loan account. So it's like a cheaper version of an offset account, you know. So.
Sure. So there's this sort of, I'm assuming there's two sort of loans. So there's a variable rate and there's a fixed rate.
Yeah, there's fixed
right?
rate.
So what's the sort of differences between those?
Okay, well, the variable rate will fluctuate with the market, and then the fixed rate is you're basically having a gamble that if you're going to fix it at that amount, then you're going to be better off fixing it, whether it's 1, 2, 3, up to 5 years, right? I'm sort of recommending to my clients at the moment not to fix anything because we're still expecting a few more drops with the interest rate. If we see that the trend is turning upwards, we still got a few rises before we start to really worry. Because like you said, we've got the best rates we've ever had. Even if we had three or four rises from where we are now, we're still in a great position.
Oh, definitely.
You know, so
right. I mean, it hasn't been under 4 for a while, right? And now we're in the 3s and low 3s even at that for an interest rate, which we've never really seen before, right?
Yeah,
so
that's right.
yeah, it's probably smarter off doing that variable rate at the moment instead of that fixed cost. So every 5 years, you're saying that's the most you can do for a variable rate?
For fixed rate. Fixed rate is the maximum that you can fix it for, right?
Okay.
But the problem with fixed rates is you're basically tying yourself down. So in terms of flexibility and being able to switch and do all that sort of stuff, your variable rate is the most flexible. And once you fix, there will be break costs involved if you want to get out of that product. If the rates have dropped because the bank's losing out, right? So you're basically gambling that, or you're protecting yourself against rate rises. But if the rate drops, then the bank's going to lose if you get out of it because you're now stuck in at a higher rate, right? So they're making money on you.
Wow.
So they'll charge you thousands of dollars to get out of it. If the rates rise and you want to get out, then it's not so much of an issue because the bank still wins because now you're going to get out to a higher rate. Yeah. You know, so you might move to a variable rate just because you need the flexibility or whatever the case. You know?
So can you always move in between fixed and variable or?
Well, it depends on the market, right? So again, if you're in variable rate product and you want to switch to a fixed, then we can arrange that. But if you're in a fixed rate and you want to get to variable, you either pay the fees if there's any fees involved, or you got to wait till the end of your fixed rate period. Yeah. And then it will automatically revert to a variable rate. But usually, whenever anything reverts, then it's going to go to your standard variable rate. So at the end of every sort of either fixed rate period or a lot of the cheaper variable rates have 2-year intro special or whatever. At the end of those special periods, it reverts to the standard variable. So that's why we say every 2 to 3 years you should be reviewing your home loan, because I've got clients at the moment who still have rates above 5% purely because they don't pay attention to it. So they've had their glory period and now they've been stuck back on the standard variable.
So that'd be a refinance then.
Refinance. Well, it depends. We can either then stay with that lender if the client's loyal to it and they're still in a good position in the market. And just, we do a variation and change to the product we need to, or we'll change lenders completely if there's a better option.
Okay. So we're at the application process now. Mm-hmm. So how long does that application process generally, I know it's not like a set sort of time limit, but like in general? Okay.
So from submission, right? From the submission, we will usually hear back within 5 days. So I usually quote my clients 5 to 7 days, and if we'll usually hear before that. I like to over quote the time and
Overpromise, underdeliver. Yeah.
No, well, under promise and over deliver. Not over promise and under. I'd be over promising if I said 3 days, right? Yeah. But you know what I'm trying to say.
No, definitely.
So overquote the time and come back within expectations.
Yeah.
Plus, it just gives them peace of mind. We're not expecting anything 5-7 days, so let's just chill out a little bit. Otherwise, you can get a few frantic clients. It's been 2 days, haven't heard what's going on. So, but that can, like the banks, they fluctuate from week to week, day to day, even. So one bank might come up with a rate change or reducing, some sort of special, and they get slammed with applications for a week. That can blow them out 3, 4, 5 days.
So it can take you a couple of weeks to get it back.
Yeah, well, I was dealing with a lender just over Christmas who they were at 3 to 5 days and they blew out to 9 days.
Wow.
Yeah. So.
Wow. So they must have done some sort of incentive for people to come in, right? Okay, and is that brings you sort of to a pre-approval stage, or?
Well, that's to hear back from the bank. So either at that point. Depending on how good or detailed the submission was, you either get to a conditional approval based on a valuation of the property, or it will come back and say, hey, look, we just need a bit more information around X, or we noticed that they've had these credit inquiries on their credit report. What happened with them, So it will either get to a conditional approval or basically more information request. Okay.
All right. So then once that, obviously, the more information is handed over, then you get to that sort of pre-approval stage?
Yeah. So once, and to be honest, within the last 3 months, banks have been a little bit annoying with this because they'll come back and they'll ask for more information around something. So we'll provide that, and then they'll come back 2-3 days later, because every time they ask for something else, you go to the back of the queue, so you have to wait
keep waiting those days,
2 or 3 days, right? And they look at it again. Yeah, cool, we'll tick that off. Oh, but now we want this. Okay, so then you go get that and bring it back. Oh, but now we want this. They're being very stringent, and again, I think it's just because the market is just in such a new space. There's so much happening at once, with the assessment rates and the interest rates. No one really knows what's going on with how to evaluate the living expenses, so it's just in a bit of a shock at the moment.
It's sort of coming back around to being normalised again, because I know it got real crazy sort of before the election, and markets were dead, and people were scared, and banks weren't lending, and people thought they could get, say, 850 borrowing capacity, and they come back and they're only getting 600 or whatever it may be. So it was changing people's situation a lot. So when that happens, obviously they can control all different parts of all markets, finance, real estate, whatever it may be, because it's all to do with money, right? And now, even though they're talking about bringing in sort of a land tax proposal too, which again would affect people who are a bit more established and have multiple investment properties, because your land tax bill will just go through the roof, astronomical as well, right? But that's separate, obviously, to first home buyers. But I mean, that's just how the market's sort of going at the moment, right? But okay, so we get the approval stage. Now, I'm a first homeowner. To lock away that first homeowner's grant, which is $15,000, right? How do I go about getting that first homeowner's grant?
So you have to be a citizen or permanent resident. The property value can't exceed $575,000. You need to live in the property straight after you purchase it. Can't buy an investment property. But it's basically filling out a form and sending it into Revenue SA and the bank and getting it done. So it's not too much involved in it.
And when would you get that money? Would you get that sort of on the settlement of the property, or when you're putting down the deposits?
It goes into the property transaction. So you won't actually get it. There's 2 ways. You can either just make it as a part of your deposit, so it will get put into the transaction, or you cover that amount and get reimbursed. Okay.
So there's 2 options when doing it, really.
Basically. Most people just let it go in, so they don't have to wait for a reimbursement.
So if I'm a first homeowner, but I'm looking to invest in a property, right? To lock away that first homeowner's grant, do I have to live in the property for a certain amount of time to get that?
I think, off the top of my head, it's 12 months.
Okay.
12 months.
So between 6 or 12, usually they change it every now and then too. And then after that 12 months, then you apply for that 15,000, or is it already there at the start? And
No.
yeah.
So it's all part of the transaction at the start, at
Yeah.
the front end. So then you live in it 12 months, and then you're free to do what you want.
Okay, fantastic. And then, all right, so say like I'm a first home buyer. I've lived in it for 12 months. Now I want to rent it out.
Mm-hmm.
I was lucky enough to put a bit of equity into my property because I bought with all these incentives on from, the $15,000 first homeowners grant. I got, $25K from the developer and a stamp duty rebate, you know. So I've already got from the purchase time, 40,000, 50,000 already built in as capital.
Mm-hmm.
From buying pretty smart and in a smart location, good house, and whatever the incentive was, right?
Yeah.
I've got a little bit of equity now too. Now, how do I turn that equity
Mm-hmm.
into another property?
Yeah, okay. So that would take a refinance, to draw out that equity, or a top up, right, of your current loan. Now, when you do that, you can only borrow up to 90% of the property value. So when you purchase, you can borrow up to 95, but if you're refinancing or drawing on equity, then it's only up to 90%.
Of the property I've already purchased, or the one I'm looking to purchase?
Of the property you purchased.
Okay.
Right? So say your property is worth let's make it $1 million.
Yeah.
Just because
Keep
I'm not good at
nice and
maths.
easy. I know in finance, not good at that. I doubt that.
Right.
No, we'll keep it nice and round. Yeah.
Right. $1 million, right?
Yeah.
And say you've got say you purchase. If you purchase, your loan amount can be around $950 and 95%.
Sure.
But you've now, over a year or two, you've paid down to $700,000.
Yeah.
Now you can draw out up to $900,000.
Sure.
Right. So 90% is all you can take it up to. But purchase, they'll allow you to go that bit extra.
Is that right?
Mm.
So if you buy smart,
Yeah.
right, and in somewhere like some suburb where you're going to get a little bit of that capital growth because your valuation will come up a little bit, you've already purchased with incentives on the property, so you've got sort of burning the candle from both ends, really, right? When you're thinking about it.
Mm-hmm.
So if you're smart about it, you can pretty much use that equity to get yourself a second property pretty quickly, right?
Yeah.
If you build that capital into
That's
it.
right.
Yeah.
That's right. What I tell people is usually give it at least 2 years, 18 months to 2 years, and we'll get another valuation, and we'll see where you're at. But yeah, if you get those grants and don't substitute what you were going to put into the property for those grants, and you just use them as a bonus to buy that equity, then definitely you can be in a good position pretty quick.
All right. And from your expertise, because you're doing a lot of deals at the moment with all different sorts of people, what are the signs you're seeing out there with trends of the market? Do you see people sort of leaning towards one sort of area, or is it still just spread across everywhere at the moment?
Everywhere.
Yeah.
I mean, you've got your first home buyers that are sort of being forced into certain pockets purely for price and development. But then, you've got your up and coming self-employed applicants or people on good PAYG that they want to go live somewhere like Kernel Gardens, so they want that, I wouldn't say flashy, but a bit more of a status symbol type scenario. They want to send the kids to private schools, drive the Range Rover and all that sort of white picket fence type style. So it's everywhere, so it all depends on the person. It's the one thing that you learn, and you might see the same, but it might be different from the real estate point of view, is that there is no duplicate transaction or applicant.
Ever.
Right,
there's always something different with every situation that you get thrown into, right?
Mm-hmm.
Which is good, because the more situations you get thrown into, the more experience you get, and obviously the more hurdles you can overcome and expect things in the future. And you go into the situation a lot more aware of what's going to happen, right? But with the first home buyers, you're right with their price point sort of pushing them into a certain product in certain areas, because in Adelaide at the moment, you're usually around 300 to 400,000 just in general for majority of first home buyers, which in certain areas puts you into sort of apartments and smaller townhouse style living, right? First home buyers at the moment, they're not too many of them looking at the established homes, purely because they do need the grants to sort of help them make up that gap in the amount that they're loaning from the bank, right? Do you find many first home buyers looking at established property at the moment?
Some, some. You know, a lot of people in the mining industry, where they don't really need to rely on that 15 grand. But also, if they're smart, you know, again, I tell first homeowners that don't look at it like your forever home. Yeah. You know, look at it as an investment. Live in it for 12 months and then move on. That's
a great piece of advice, really, because I mean, in general, people change homes at least like 2 or 3 times, some multiple. I mean, I know Calm, you've moved about 15 times, Calm? Yeah. He's moved 15 times in his house, which is a lot, right? Mm-hmm. But, you know, his parents are in real estate, see good deals, and, you know, they're doing their thing, which is great. Yeah. But he's always said, like, it was hard to move 15 times as well.
Oh, yeah.
So I guess the main thing is to sort of know your situation. First, establish whether you're an investor or you're going to be moving into it, I guess, for the first thing, right? Mm-hmm. And then sort of dictate your game plan from that. Because if you're moving into something, obviously there's a few more things that are a bit more important to you than if you're an investor into something like, exactly. You want to, you know, if you want a gym at home or something like that, if you want a bit of extra space in your laundry or whatever it may be, you're going to tailor it to yourself and what you like. Because, you know, if I'm living with minimal wardrobe space, well then a walk-in wardrobe for me is going to be an important thing because I need that extra space for all my clothes and that sort of thing too. Whereas an investor, you know, I can get away with just doing the double built-in robes because it's going to be enough for anyone who's renting the property too. Exactly, so I guess the first step is to really understanding who you are as a first home buyer. Mm-hmm. And then next would obviously go to see a broker like yourself, find out your financial capabilities and then plan ahead, obviously, because it's the market's constantly changing. And everyone's situation is different, and what your friend did isn't necessarily going to be able to happen to you, or they might have got a worse deal or a better deal or whatever it may be. Exactly. It's all about the timing of the market, right? So I guess that's pretty much the sum of the best piece of advice today, like for the first couple steps. And then obviously when they come see you, look at your lifestyle expenses and that sort of thing too, right? Yeah. I mean, any other advice for the first home owners today? Or that's...
Well, no, I sort of tell people, let it be your own journey of discovery. You know, the amount of times again that I get people come to me, oh, my dad told me this or my mum told me this, and it's like, that's great, you know, we all love our parents, but for most of them it's been probably 30 odd years since they bought a house, you know, especially for people our age. So it's changing so much that we actually have to keep on top of things from a week to week basis. So yes, take their advice on board, but don't come into the market and think that that's how it's going to be, you know. Obviously take bits and pieces from everywhere, but, you know, just be a sponge of information, you know. So,
and that's the thing, you're always constantly learning, always constantly evolving, that sort of thing too. Mm-hmm. And you brought in parents there too, which is remind me of another point, right? Because I do see a fair few first home buyers that have guarantors on their loans. So do you want to talk just a little bit, we'll just touch on it quickly, just about guarantors and what that sort of means for the transaction in relation to that?
Yeah, so there's security guarantees, which is basically if your parents want to help you out with the deposit, then they can put up the security from their house or the equity in their house. So the banks will take 20% of the purchase price plus the fees. So it works out to about roughly 25% over the parent's house. And then the rest will be a loan against your property. So you're basically borrowing the full amount, right? But it's backed by the security of your parents' house. So you then are paying 2 loans off because it will come in 2 splits. And you just got to pay it down. So I usually recommend to people to put their split against their house on interest only for a few years because lesser repayments, and then smash down their parents as much as they can. But
okay, so you're saying the first homeowner put it as interest only for the payments because you'll have lower payments.
Lower payments on their split because you'll have a loan against your house essentially and a loan against your parents' house. Okay. Right. So you want to pay down the parents as quick as possible, right? Yeah, but then also if you're going to look at that and the parents do have equity in their home, again, it might be more beneficial just for the parents to draw out the cash, because if you're then looking, like for them to set up a security guarantee from the bank's point of view, it's very heavy in the legal work, so they're not going to do it for 5% deposit or 10%. That's why their benchmark is 20% plus the fees, right?
Yeah, that makes sense.
So if your parents were just going to draw out the cash, then, you know, say if you're buying a $400,000 property for a first homeowner, they might be able to draw out 30 to 40 grand worth of cash, just lend it to the kid and
it's not going to be
or gift it to them even. Rather than having 20% might have up to 115 grand of their security or equity tied up.
Makes a lot more sense doing it like that. Well, it depends on the structure of the
well,
parents set up, right? But I
again,
mean,
each to their own.
Each to their own. So that's pretty good to know, because there's a bit of questioning around guarantors and if it's safe enough, and if it's a bit more higher risk for parents and that sort of thing too. Right?
It's classed as a limited guarantee. So if you default, all they can come after is the amount that you've guaranteed. It's not like they can come after the rest of your property. So, but that's still a drama within itself, because you either come up with the cash to pay it out, or you have to sell your house in order, or you might not have enough equity to draw the amount that you've just tied up for your kids. So then that's where the problems.
So I guess the learning experience from that is to make sure you can afford the repayments, right? Because like everything in life, if you're going to buy something, make sure you can afford to pay for it, because if you can't, then that's when the problems start happening, right? That's right. Which brings us back to the broker and why it's so important to see the broker at the very first part of it all, to go over the situation and let you know you're going to be comfortable in spending this. I know you want to spend this much, right? But if you want to be comfortable in doing it, this is what I recommend that you do, right? And sort of work backwards from that, right?
I mean, that's the classic what can you borrow versus what you can actually afford. So you can max yourself out, but the first little hiccup you get along the way, you're going to
cop it.
Otherwise I can borrow is this much. Let's take it a couple steps back. We'll get in. We'll be comfortable. We're stress test if anything is to arise.
Fantastic. Well, mate, thanks for coming on today. I really appreciate it. That was really insightful. I mean, I took a lot from it as well. I hope our listeners do as well.
Look forward
to it. But thanks for coming on, man.
Thank you.
Awesome.
Anytime. Cheers.
Appreciate it.